Before we begin, I want you to imagine something simple. You log into your brokerage account, ready to check the investments you've been building for years. The numbers look comforting, the tickers are familiar, and everything feels secure. But beneath that calm interface lies a legal reality almost no retail investor understands, a reality that determines who actually owns your wealth when the financial system starts shaking. Today we're lifting that curtain. And once you see what's behind it, you'll never look at your portfolio the same way again. Pop quiz. If you opened your brokerage app right now and saw 10 shares of Apple sitting there, who would you say owns them? Most people instinctively answer, I do. And that answer, although natural, is legally wrong in a way that could cost you everything in a financial crisis. Let's go straight to the law that governs securities ownership in the United States, the Uniform Commercial Code, Article 8. Right there, in plain legal text, it says that when you buy a stock through a broker, you don't receive direct ownership of that share. What you receive is a security entitlement, a contractual right to the economic benefits of the asset, not the asset itself. That subtle difference changes the entire story of who controls your wealth. Here's what actually happened when you clicked buy on that Apple order. Your money went to your brokerage. The brokerage sent instructions to a clearinghouse. The clearinghouse updated a massive ledger overseen by the Depository Trust and Clearing Corporation, DTCC. And somewhere inside a pooled account holding trillions of dollars worth of securities, a number changed. But the legal title to that share? It didn't move to your name. It stayed under Seed & Co., the nominee name of the DTCC. You became a beneficial owner. They remained the registered owner. To understand how bizarre this structure is, imagine you saved up and purchased a hotel room as an investment. You pay, you click confirm, your account displays one room owned. You feel great until you discover the fine print. You don't own the room. The hotel does. You only purchased a permanent reservation. You can use it, you can profit from it, but the deed never changes hands. And if the hotel collapses financially, your reservation becomes a general claim in bankruptcy court, behind secured creditors, lenders, and everyone else. That fictional hotel isn't a metaphor, it's a mirror of how American stock ownership actually works. According to the DTCC, they hold more than $63 trillion in securities under their nominee name. That represents the shares held for virtually every investor using Fidelity, Schwab, Robinhood, E-Trade, or any other major brokerage. When you see your stocks in your portfolio, you're really looking at your broker's promise to pass along the gains, dividends, and voting rights of shares legally titled to someone else. For years this arrangement didn't matter. The system appeared stable. Brokers found buyers, transactions cleared smoothly, and investors received their money. The difference between being a registered owner and a beneficial owner felt irrelevant. But that illusion depends on one thing, stability. And that stability is cracking. We're heading into 2026 carrying the largest debt burdens in human history, a derivatives market exceeding $600 trillion, and a commercial real estate sector buckling under its own weight. The Federal Reserve has quietly acknowledged that the banking system faces potentially catastrophic losses. Several Fed governors have openly warned about fragility in the securities lending market. International regulators, from the BIS to the IMF, have pointed to dangerously long collateral chains connecting nearly every major financial institution in the world. This means one major default could trigger a cascade of failures across the entire system. And when that happens, the legal difference between entitlement and ownership becomes the difference between keeping your savings and watching them evaporate. Consider your retirement portfolio. Maybe you've built it for decades, dollar cost averaging into index funds, watching your balance slowly rise to $200,000 or $500,000. You've always believed you own those shares. But legally, you own a claim against your broker for securities held in a massive pooled account. Your rights sit behind the broker's creditors, the custodian banks, and the financial institutions that rely on your assets as collateral. This is where the counterparty risk begins. You don't just rely on your broker. You rely on their custodian, and the custodian's lenders, and the lender's derivative counterparties. Because your shares, your hard-earned investments, are routinely rehypothecated. They're pledged as collateral for loans made to the financial institutions that hold them. IHS Markit estimates more than $2 trillion in U.S. equities are on loan at any given moment, usually without the retail investor ever knowing. Everything functions until it doesn't. Banks today are sitting on more than $500 billion in unrealized losses. Commercial real estate delinquencies are rising fast. Corporate debt refinancing needs are exploding while interest rates stay painfully high. Credit default swap spreads are widening, signaling that markets are preparing for major institutional failures. Building into 2026, we're facing a perfect storm. Corporate debt from the zero-rate era is coming due. Regional banks remain fragile. Derivatives exposure is deeper than in 2008. And the legal structure protecting investors is built to serve the largest institutions first. None of this is conspiracy. It's openly documented. The laws are public. The bankruptcy priority hierarchy is clear. Retail investors simply never read the fine print. And that fine print states that if your broker fails, you become an unsecured creditor at the very back of the line. Secured creditors, large banks, get paid first. Then the bankruptcy lawyers, administrators, and tax claims. Then unsecured corporate creditors. Finally, at the very end, customers with security entitlements. That's you. SIPC insurance? It sounds reassuring, but it only covers broker fraud, not systemic collapse. With roughly $4 billion in its fund, one large failure would wipe it out. And we've seen what happens when a system uses bail-ins. Cyprus did it in 2013, seizing nearly half of depositors' savings to recapitalize failing banks. That framework wasn't improvised, it was designed by global regulators. And the United States adopted the same structure in the Dodd-Frank Act. Title II gives the FDIC authority to impose orderly liquidation, including the power to treat similar creditors differently and use customer assets to stabilize the system. In other words, if the next crisis hits, your shares may become the system's emergency oxygen. And unless you understand how the architecture works, you won't know why it happened, or why your account balance is suddenly a legal debate in bankruptcy court. In 2014, the Financial Stability Board released a document with an innocently bureaucratic name: Adequacy of Loss-Absorbing Capacity of Global Systemically Important Banks and Resolution. Hidden behind that dry title was a radical shift in global finance, a blueprint for what happens when the world's biggest banks fail. The solution, according to regulators, wasn't taxpayer bailouts. It was something far more direct. Banks would rescue themselves by turning their liabilities into equity. And what are those liabilities? Your deposits, your brokerage assets, your securities. In a crisis, they become the bank's emergency capital. We caught a glimpse of how fragile things truly are in March 2023, when Silicon Valley Bank and First Republic collapsed within days. The FDIC rushed in over a weekend, seizing both institutions. Depositors above the insured limit briefly faced real losses until the government intervened with extraordinary measures. But those actions required political agreement and available funding, two things we cannot assume will exist in the next crisis. Now imagine the same scenario in 2026, except it's not two regional banks collapsing, it's 10 major institutions failing simultaneously. What if the Federal Reserve's balance sheet has already been stretched to its limit? What if Congress is paralyzed and unable to authorize emergency support? In that world, the safety nets vanish. The bail-in process activates automatically. And the most unsettling part? The digital infrastructure to perform instant confiscation is already operational. We're racing toward a financial system built on central bank digital currencies and tokenized securities. The Federal Reserve is testing versions of a digital dollar. Major banks are developing blockchain-based settlement rails. The DTCC has announced plans to tokenize securities and push everything toward real-time settlement. The marketing pitch says this is efficiency and modernization. But baked into this new system is a chilling capability: the power to freeze, seize, or erase financial assets instantly. Think of what that means. In the old world, confiscation required physical action. Someone had to enter a bank, flip through ledgers, physically restrict accounts. There was time to react. In the digital world, your wealth is nothing more than a line in a database. A single algorithmic command can change your balance from $500,000 to $0 in milliseconds. No warnings. No bank runs. No escape. The system locks before the public even realizes a crisis has started. The IMF openly discussed this in a 2022 working paper, framing CBDCs as tools that could enforce capital controls or financial repression more efficiently. The language was polished, academic, but the implication was unmistakable. Digital money grants institutions unprecedented control over private wealth. Once your assets exist only as entries in centralized databases, you don't truly own money. You are merely permitted to use it until that permission is removed. This is why the shift from physical certificates to digital entitlements matters. Each step of modernization has reduced your direct control over your own assets while increasing the system's ability to appropriate them during a crisis. And the people who architected this ecosystem? They're the same ones who stand first in line to benefit when it activates: the secured creditors, the too-big-to-fail banks, the institutions whose collateral chains run straight through the securities in your brokerage account. Now picture the crisis unfolding in 2026. Derivative exposures begin to unravel. Margin calls ripple through the system. Several large banks rush to find collateral, and they find it in the same place they always do: customer assets. Brokerages freeze withdrawals just like Robinhood did during the GameStop saga, except this time it won't be temporary or limited to one stock. Accounts will be locked while bankruptcy courts determine who gets what. Depositors and investors will be forcibly converted into equity holders of collapsing institutions. The largest wealth transfer in American history will happen legally, not through theft, but through regulation. This is not a bailout. It is a bail-in. Your assets become the rescue fund. And it's not some hypothetical future. The legal mechanisms already exist. The systems already work. The precedents are already written. The only missing ingredient is the trigger, and if you're watching commercial real estate, corporate refinancing cliffs, or bank unrealized losses, that trigger appears to be closing in fast. But there is a way out, a way to reclaim real ownership before the trap closes. It's called direct registration, the only method for a retail investor to become the registered owner of a stock rather than just a beneficial owner, holding a fragile entitlement. When you direct register your shares, they are removed from the DTCC's pooled accounts and recorded directly in your name on the company's shareholder ledger. Once those shares are in DRS, they cannot be seized to satisfy your broker's debts. They cannot be rehypothecated into derivative chains. They cannot become part of a bankruptcy estate. They are legally yours, real property with your name on the title. Meanwhile, assets with zero counterparty risk, physical gold, land with clear title and self-custodied Bitcoin, exist completely outside the system that is preparing to cannibalize its own participants. Central banks themselves have been hoarding gold for the same reason. In a systemic collapse, gold cannot be bailed in. It is no one's liability. A portfolio prepared for 2026 is not defined by diversification. It is defined by actual ownership. If you don't hold it, you don't own it. If your wealth sits inside the financial system, it can be absorbed by the financial system. And when the next storm hits, not months apart but perhaps over a single weekend, the investors who survive won't be the ones with the best stock picks. They'll be the ones who understood property rights, who moved early, who shifted from claims to assets. Because when the bankruptcy judge begins sorting through the wreckage, there will be only two groups left: those who hold real property outside the collapsing system, and those who hold claims against institutions that no longer exist.